This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. So episode 67 today, and we had a guest who, in the United States, she's a pretty big deal in the personal finance world, probably less known in Canada, but Cameron, you met her for lunch, and maybe you want to talk a little bit about who she is.
Yes, so her name is Jill Schlesinger, and got a chance to meet her through a common friend in New York City a few weeks ago, and wow, what a dynamo. She was phenomenal to meet. Fascinating lady, interesting background. She was a trader on Wall Street, and then she became a financial advisor, and then for the past 10 years, she's been in media. And you might know her name from seeing her on CBS News. So she's on Sunday morning, CBS Sunday morning show once in a while, as well as the evening news. She's on a nationally syndicated radio show on CBS. She has a podcast called Jill on Money. Interesting, some of her podcasts, she has people call in with questions, and they're very good.
You kind of glossed over it, but she was a commodities trader, like on a trading floor, which is pretty crazy. That's how she started her career. She went on to have her own firm. Like, it's not like she was just a CFP doing whatever. She was the chief investment officer of a firm for 14 years. So she's got a pretty serious financial background. And now, like you just said, Cameron, she spends all of her time talking to people about financial decisions. So she has a ton of great insight. It was a really good conversation.
But that combination of being a trader as well as an asset manager to working with clients, now being in the media, it's a fascinating mix. And to hear her with the whole New York City environment that she lives in was really cool, actually.
She's a serious person. She graduated from Brown University. Like, she's beginning to end, no joke.
She's also the senior CFP board ambassador to the CFP Board of Standards. So she's no joke on the planning side too. She's the real deal. And boy, can she communicate well.
Oh yeah. Yeah. She was up there as far as the best communicators that we've talked to. And her, but like you said, her ability to tie together that obvious, intense technical financial knowledge with the understanding of human behavior, and then the ability to communicate that in a way that other people can understand. I was blown away.
Super. Well, hope you enjoyed the interview. Jill, welcome to the Rational Reminder Podcast.
Well, thanks for having me. I've waited forever to be invited. Finally, I got the nod.
I got the nod. Well, I'm so happy to have you to join us, and I'm grateful to our mutual friend, Michael, for the kind introduction. So again, thanks.
Well, I usually don't trust Canadians in general, but I made an exception for.
Wow, and Ben by being part of the team.
Well, it's all right. We'll get to that later when we talk about what is success. I'll try not to mention hockey, okay?
Yeah, thanks for that. Okay, so you're a professional podcaster, so let's kick it off with a question that we have for you. Smart people make a lot of dumb financial decisions. I think you would agree with that?
Yes, I wrote a whole book about it.
So in your book, you talked about them and you call them blind spots. Can you just talk about some of the common blind spots?
Well, I just think that most of us tend to be guided by either fear or greed when it comes to money. And I'm sure you guys have talked about this on the podcast. There's a series of underlying behavioral economics theories that really do play into why we can often make choices that are not optimal. And of course, that flies in the face of standard economics, right? You get some economist who says, well, where this line meets this line, that is supply meets demand, that's equilibrium, that's what happens. Except then real life takes over and you're like, wait a minute, that didn't work out that way. And so what we now know is over time that human beings, sadly, because we are human beings, tend to let emotions guide a lot of our decisions. And that's why we feel better putting money into our retirement accounts when markets are trading higher. And we feel scared and anxious and nauseous. And we don't think, wow, this is a great buying opportunity. No matter how many times people like you and me quote Warren Buffett, people are not going to feel happy when the market is going down and they are investing. So it's a conundrum to be a human being, isn't it? The financial world is just one expression of that.
In your book, you used yourself as an example, and I mean, you started your career as a trader on Wall Street, which is pretty cool as a side note. But you described how that actually led to some overconfidence where because you were a trader, you felt like you might know a little bit more than everybody else, but that confidence didn't last forever. Can you talk about how that confidence went away?
It goes away usually in a minute. And usually you feel like a brilliant person for exactly a minute on a trading floor. Look, I think as a trader in the late 1980s, so now I am revealing myself, coming out as an old person, what I can tell you is that there was an edge to being on a trading floor because you saw the buy orders come in, the sell orders come in. So you knew when 100 people are shouting at the top of a trading ring, and they were only saying sell and pushing their hands in your faces away from themselves, that's a sell order, that you now understood that the tide had turned and that if you could potentially step in for a second or try to capture a tenth of a percentage point here or there, that you could make some money. But that's not investing. And what I learned when I started to really invest money for the long term on behalf of clients and really got my first butt kicking was the end of the 90s, beginning 2000, where I felt very strongly that the technology sector had gotten overdone. I saw the whole swath of technology. I went and talked about it. I wrote about it. And I was really brilliant for about a year, maybe 8 months. However, I quickly realized that as time went by, I never knew when to get back in. And so there I was missing the entire recovery of the dot-com meltdown because I was waiting from, some sign on high. Was Moses going to deliver that from the mount to me? I guess I thought so. And I did not. And I then realized I did not know how to time the market. And it's one thing to kind of time the market for a little something here and there where you want to get your yayas. Okay, that's fine. But for your long-term investment portfolio and your philosophy, you can't do that. And I learned that lesson. It was a bitter pill to swallow. I wrote about it. I learned it. And I wanted people to understand that even somebody who is so connected to financial markets for so much of her life, that I could fall into the exact same traps as anyone else.
So the next question ties into that, Jill, and this is the one I've been dying to ask you for a while now. And this is a good one based on your background. So you were a trader, you were an advisor like us, and now you're part of the media. So every client and person we've talked to pretty much of late talks about the inverted yield curve and the pending obvious recession that's going to hammer stocks. How does someone with your experience set, and especially the role of the media in influencing people and how they behave, how do you frame this? And how do you think about helping people stay rational during these times?
So I've just come off of a 2-week vacation during which I had to be on CBS Evening News 2 different times. And the first time was when the yield curve inverted. And that was maybe the first trading day of my vacation. I got a call from a producer who said, could you explain to me in a very easy for television way what an inversion of a yield curve really means? I said, well, it really means that normally when you lend money for a longer period of time, you get paid more interest than when you lend money for a shorter period of time. And he's like, oh, okay. So but why is that bad? I said, well, it's not bad. It's just sort of in a weird way, like when that relationship flips on its head, something weird's going on. And that weirdness could portend something. It might not. And so they didn't do anything with it. But then the next night I had to go on the air and explain, why is it that the stock market went down by a couple, 2.5%, and what the inverted yield curve really meant. And I did go on the air. And at the end of the segment, what I said was, listen, nobody needs to change their lives right now. Just because a relationship comes to pass that could mean that a recession might be coming is not really newsworthy. There will be another recession. No one has repealed the business cycle. But people should just go on living their lives and being responsible to the things and the tasks in their financial lives that they can control. And half of the hate mail that came in was that I was irresponsible for saying such a horrible thing to live your life. the other half of the hate mail was, you dodo, don't you understand that this means a recession is coming? You should be warning people. And then the other half of the people, so a quarter. Now the other half of the responses was, thank you for not making me feel crazy. So what am I to take from that? That when you try to tell people to be cool and rational and know that, yes, you're going to live through an expansion and a recession and an expansion and a recession, and you really just have to kind of live your life. I would say half of the public feels very comfortable with that. And then the people who don't like that want you to be the person, the wizard behind the curtain, to tell them exactly what to do and how to profit from what's going on. So what I think my responsibility is in discussing the news and trying to really help people understand the situation is to say, here's why this information is making a headline, but here's what you need to do or what you should not do with that information. And in 98% of the time, most of my advice is you're allowed to feel what you feel, but you should not act on that feeling. The only time I say you should act is if you've made a mistake going into the period of time. If by mistake you went into a terribly volatile time and you had too much risk and you've got to write a check for a tuition bill or you need a house down payment and you never should have had money at risk in the first place, then you really do need to do something. You need to get your money out of this risky environment and you need to take action to protect it. But other than that, unless you've made a huge mistake on the way in, your best bet, don't do anything.
So you talked about how there are you got these two different types of responses from these two different types of people. And I'm sure there are more than two types of investor out there. But when you think about the way that people are wired, do you think they're wired differently? And of course they are. How do you think people should be compensating for that or accounting for that when they're planning how they're going to be investing their money?
Well, when you say wired differently, what are you thinking about? You talk to people all the time. Are you thinking that there are some people who are generally more conservative and some people who are more aggressive?
I think there's a risk tolerance component. I think that there's also a tendency to think more rationally versus more emotionally.
Yeah, I haven't met a lot of those rational people. Maybe if I had more of those as clients way back when, I'd still be in your business. I think there are some people who want to believe that there is a magic solution to cracking the markets. And the industry does a lot to foster that belief. We have the best mutual fund managers, which is baloney. We have the best algorithms, which is baloney. We have the smartest, best mix of exchange traded funds, baloney. What I've come to really understand is that people don't actually want to know that if you boil investing down to a very simple concept, it feels frustrating to them because there is money at stake. Their financial futures are on the line, and they want to believe that this is a science. It's not a science. I had a friend who once told me, she's a doctor, and she goes, being a doctor is half science and half art. And if you get the science part right, you only have half a chance to screw up your patient. And I feel that way about financial services. It's half science, it's half art. And the role of someone like, for you guys, why you get compensated so well is that the scientific part, which is actually not the investing, which is the hardcore planning, the number crunching, the listening to your clients and understanding what their needs are, what their wants are, what their desires are, and your solutions, that's, of course, the scientific part. The art is trying to keep them on track so that they remember why they came to you in the first place. But as we all have realized, there are patients who will shop around to find a doctor who tell them what they want to hear. There are clients in financial services who will shop around and say, oh my God, I finally found the gal who's the smartest in the world. It's the best hedge fund. It's the smartest private equity. It's baloney. It's all baloney. But they don't want to hear that because then it sort of dismantles this whole concept of, well, then why should I pay anybody for help?
Great answer. And the other thing that forms part of this too is someone's past experience. So if you lived through the crash of 87 or 2000 or 2008, depending on your time around there, that can have a huge impact as well.
Oh, absolutely. I mean, one of the best things that happened to me is I became a trader in 1987. And so I lived through a crash. And I was trading on the commodities exchange at the time, but my father was a specialist on the floor of the American Stock Exchange. my father and my mother were traveling in Italy the day of the crash. Early morning in October in 1987, I had a little beeper that was a very slim and cool beeper, by the way, before we had cell phones. And it was in my pocket. The beeper went off, and it was my father's business partner. I called up his booth and I said, "Hey, George, what's up?" He's like, "Where's your father?" I said, "I don't know. I think he's in Florence. Get him home now." I said, "What do you mean?" He said, "I have the orders. The number of orders I have right now tells me that I'll be out of business in the next day. Tell your father to come home, bring his checkbook." So at the end of that day, I actually went over to kind of clear out and help them. I had made a whole bunch of money in the gold market because gold went limit up that day, meaning that gold went up because everyone was freaking out, thinking the world was coming to an end. I saw grown men crying, men that I had worked for every summer. I saw all these really big swinging, guys and gals on the floor who were freaking out, who had lost their businesses. And I understood what risk meant in that moment. And I understood that this thing called a bull market can evaporate pretty quickly. And I also understood that the one thing my father and I were talking right before he got on the plane to come back to New York, and he said to me, "How much money do you have in cash right now?" And I said, I don't know, I had $10,000, which was a lot of money, by the way, in 1987. "What about your sister?" I said, "I don't know, I'll find out." He goes, "Take all the money you have and do me a favor, buy these 15 stocks in each of your accounts." So he was about to lose his business, but the one thing he realized was, hey, this is an opportunity right this second. So my sister and I bought some stocks, and it was like a good foundation. It was actually the beginning of my house down payment fund.
What a story. When you're talking about your parents, when you think about couples, like we're talking about people who might be wired differently inherently, they might have different past experiences. If we have a couple with very different money personalities, whatever you want to call it, what do you think is the best approach for them to make good financial decisions together?
Well, I mean, look, I think that you can have a different approach, but you've got to be on the same page with your goals. And it's funny, I interviewed a woman recently who wrote a book called Marriageology. Kind of funny, the science behind marriage. She's fantastic. Little plug for her, Belinda Luscombe. She's a Time reporter on relationships. And she really is very funny because I said, "Well, what if people don't get along about their money habits?" She's like, "Well, then that's a very good sign they should not get together." And I thought, there is something there, because what you're really scratching at is, what if our value system is different? What if I don't actually believe that saving and investing for the long term so that I have more options in the future is a pathway that I want to pursue, but my mate doesn't want to do that? That's not a recipe for success. So what I do think is that couples often they've chosen each other for the right reason. They've got the same values. Your role as a great advisor is to help kind of curate their goals, negotiate between the two of them, like, what do you think is the most important? Help them come to a conclusion. But let's say you get there and wife says, "Okay, you know what? I want to do this slow and steady. I don't like risk. I don't want to be 70% stock or risky, 30% bond. I want to be a little bit less risky." And spouse 2 says, no. I want to be risky. There can be a middle ground. There can be a middle ground where you say, well, let's do this with one account. Let's do this with another account. Funny, I've been with my girlfriend for 17 years. We laugh because I said, we've never, ever had a fight about money. Never, not once. Not to say we don't fight about other things, because I do plenty wrong. But I think that these money fights are really decoys. I think that they become fights about something else in your relationship. And so one of the things that I think is important is to make sure, if you are fighting about money, that you dig deeper and say, what is it that we are not seeing in this relationship?
So from that, Jill, talk to us about your thoughts about teaching the next generation, teaching someone's kids about money.
I think that what happens that maybe parents don't realize, we're like very much into back to school season. And I just wrote an article about this, that I think you may not recognize that your own money habits get passed on to your kids pretty early on, that your kids are starting to form their money habits by as early as age 7, that essentially between ages 7 and 20, you're done. The kid's done. That, like, those habits are formed. So what I do think is important is to recognize that you have a role here. I don't know in the Canadian schools whether they teach personal finance. In about maybe 35% of the states in the U.S., there's some mandatory curriculum that is devoted to personal finance. But by and large, this is part of your parenting, says the non-parent, of course. And you really do have to have some part in this process where you are talking about money. You are talking about saving. You are talking about choices. You are talking about debt and credit cards. And if you are uncomfortable doing this, my guess is it's because you are insecure about your own financial future and maybe you need some help. But we have to be really careful about making sure that our kids understand that money isn't all important. On the other hand, it's important enough that you've got to pay attention to it.
We talked at the beginning of our conversation about the blind spots that people can have. Do you have any intuition around when someone might be well suited to be a successful do-it-yourself investor?
I always have said, do you have the time? Do you have the know-how or the expert? You don't have to be an expert, but the time, the interest, the know-how, and the discipline. You just have to be disciplined. There are plenty of people I know who go to the gym faithfully 3 times a week, work out, get a great workout, and they're done. That's it. And there's the people like me who say, if I'm not walking my dogs, I'm not walking into the gym. So I better have a trainer sitting there with me, making sure my ass is in that gym twice a week, pumping iron, doing the exercise the right way, and I am willing to pay for that. And I think there's also a question for many people who think they have the expertise. I wonder, are they truly judging their success appropriately? In other words, like a gambler, and in my past, I used to like to play craps because I like probabilities. And I think that many gamblers will tell you about all the times they've won. They very rarely will tell you about the times they lose. However, professional gamblers only talk about their losing hands.
So you have more experience and an ability than most to invest on your own, but you choose to work with an advisor. How did you make that choice?
I work with a financial advisor, somebody who is both a CPA and a CFP, because I believe his expertise is so much more important to me than me trying to sort of half-ass it. I mean, I'm a person who used to look at this day in, day out. I have great trust in his abilities. And where he brings the most value to me is not in investment management, because I do kind of feel like anyone can do that, but in his ability to help me look at my financial life in a big picture way and come up with really smart solutions to do that.
So you mentioned just now a lot of favorable characteristics that someone might seek in a financial advisor, like credentials and the ability to be trusted and give great advice and understand your situation. If someone doesn't feel like they're getting that, what kind of questions do you think that they should be asking their financial advisor?
And I think that amazingly that most people don't actually feel comfortable asking their advisor questions. So I don't understand that, but I guess that there's a certain amount of shame, or you want to believe this person's an expert. You don't want to step on his or her territory and dismiss him. I think that the big question that I start with is, what exactly is the role this person is playing in your life? Is this person providing ongoing long-term financial planning and advice? Or is this a transactional relationship where someone is going to take money and invest it for me? And generally speaking, it's okay to pay someone to invest your money for you, but you can do that yourself. There has been a democratization of investment management, and that is something that I think is not worth paying a lot of money for. But if you are working with someone who is creating a plan, helping you stay on track with that plan, retesting your assumptions on an annual basis, taking into account changes in your life, prompting you with questions, available to discuss issues like, hey, I've got 2 different job offers. How do you think I should handle this? Willing to talk to you like, hey, I got crushed on my taxes this year. Let's talk about a way that I might be able to think about this differently. Those are the kinds of things that you should be seeking in a financial planner in this day and age. Straight up money management is simply not going to be the be all end all anymore. So if you're working at some big wirehouse, like, you're at Bank of America Merrill Lynch, or you're at RBC and someone's managing your money and that's all they're doing is managing your money, what you can know is, wow, I probably could do this myself. Maybe I should really be talking to someone who can create a plan and who will help me stick to that plan.
Further to that, when we were at lunch recently, you talked about some pretty incredible data points about robo-advisors. So this mass democratization is sweeping through certainly North America. You talk about what you're seeing on the ground and what impact you think that'll have?
I just think it's the most amazing thing that, we're basically hurtling towards investment management at zero. Like, people will not have to actually pay for anything, I guess. The robos have really taken on the people who are transactional in the business. But also really interesting, they are now adding a component that's called financial advice. And I'm not sure whether it was you or Michael who pointed out to me, like, yeah, you might get financial advice, but who knows who you're going to get. And I think that that's an important thing, which is when I get financial advice, am I getting, the rookies who've just come out of their program, or am I getting someone else? Or if I to use a medical analogy, which I always like to use, here in the States, most residency programs begin in the summer. And so there's a joke, which is, please God, don't let me go into the hospital in July, because then you're getting all the brand new people just out of medical school. And you really know that while they might be smart people, they have no experience. So one of the things that I think is interesting about the robos is that they are hiring hundreds and hundreds and hundreds of the CFPs out there. Are they getting the people who are brand new, the green ones? Are they getting the ones who are seasoned? Are they getting someone like you who's seen and done so much in his career that I'm willing to pay more for you because I want to pay for that experience? And so I think that's going to be the next phase of robos, which is they can turn it on, they can get you to invest your money. How they are able to create advice that is consistent and that is going to see you through your various phases, we'll see if they can do it.
Yeah, we talk about this. Cameron and I talk about this sort of offline. It's just an economics problem. Like you cannot pay an ultra low fee and get really good advice, because people that have the knowledge to give really good advice are going to want to be compensated more. It's pretty simple.
And so then, therefore, the beauty of a robo is you no longer have to go to the schnooky salesman to buy a loaded mutual fund. You can get started in your investment life and say, okay, sure, I can go into a Schwab, or I can go into another robo platform, an investment platform, get started. But at the point I need advice, then I may want someone a little bit more experienced.
One of the things that you've written about that I also love writing and thinking about is the decision to rent versus buy a home. Can you talk about how you tell people to think about that?
I'm an unapologetic cheerleader for renting. And that was even before tax laws changed in the United States. And only because I think that I guess that I am a trader and a contrarian at heart. So when the mantra, like when something became the great American dream, I was like, really? Is it really a dream? Because I'm a homeowner and it kind of sucks. Like all around it sucks, okay? I'm not handy. I don't love that. And, I can understand the need for nesting and establishing a place that is yours. But, there's a lot of money that you put down in a down payment. Even when interest rates are low, you're still tying up that money. You're still on the hook for the maintenance. You still are tied to a house when maybe it would be nice to be able to rent or have flexibility in your career. So I think that no matter what, rent versus buy is an equation. And my mother was a realtor. She's turning 80 this year. She's not really practicing too much, but one of the things she used to love to say to some of her clients is they'd be looking and they'd fall in love with the house. She's like, don't fall in love with the house. she'd say, let me tell you this. She would often say to the man or the woman, whoever she was talking to, she's like, buying a house, you think it's your only one, but a house is like a man. There's more than one for you in the world. So don't fall in love with a house. Run the numbers. Make sure that buying a home is really what's right for you and your family financially.
Boy, is that music to Ben's ears.
Nice.
Well, we're definitely on the same page on that. Another thing that Cameron and I talk a lot about, we've actually taken quite a bit of heat for it, I guess I'd call it, where people have given us pretty critical feedback for the way that we talk about the FIRE movement, the financial independence retire early movement. Now, you mentioned that you recently interviewed somebody on this, so I'm curious to hear, how do you think about the FIRE movement, and have you gained any insight? Like, we always talk about how we don't really get it.
Well, you know why you don't get it? I don't know how old you are, but I'm older than both of you, but because you're too old. Here's what I know. I love the FI part. I don't get the RE part. So I do love financial independence. I love the movement simply because it is like all of a sudden making the idea of planning kind of cool. So that part I love. And I love the idea of saving and investing and living your life so that you have many more options in the future. That I love. I think that's great. Here's the part that I don't really get. And I just interviewed a guy who who just did a documentary called Playing with Fire. I said, I'll tell you what I don't get. He's a nice dude. His last name's Shakespeare, I swear to God. So I said, Travis, I don't get this. The people you depict in the movie, this woman was very happy in her career, and she did not seem to be overworked. She seemed like she was working hard. I don't get it. Like, she's not miserable. What do these people want? And he goes, well, they want to spend more time with their kids. They want to do this. So, and I said, but what about the psychic and intellectual benefits of working? That's what I don't get. That you, like, what are you giving up? You're going to be a parent? Great. Like, I love my dogs. I couldn't be with them 24 hours a day. Isn't there something missing here? This what I like to call like the intellectual journey of what a workday means. Now, these people, again, this was about people who were actually happy with what they were doing, right? So if you're miserable in your job, maybe I understand that. But even that, so get a new job. It's a long life. So I'm not entirely sure what else comes from them. What do you guys think?
I echo your thoughts exactly. The thing that I'm very curious about is that when we talk about this, because we've spoken about it in similar terms to what you just said in the past, and people get very upset at us about it. So I don't get that. I've heard on my YouTube channel where I've talked a little bit about this, people have made comments along the lines of, when you're working, you're a slave to society. Some pretty intense thoughts wrapped up in this, which I don't fully understand.
Well, I mean, look, do I think that there is a generation of kids who are supremely unlucky? Yes. They graduated with a lot of debt in some cases. They experienced the second worst economic downturn the world has seen in 80 years. They, maybe not in Canada, but in the United States, feel like they were abandoned in many respects by the standard promises that were made from employer to employee, by community, by their government. So I get that. That's okay. That's why I like the idea of trying to take control and putting money away. But, I interviewed these two people and I said, hey, we don't have a house. Okay. Here I am. Where do you rent? No. What do you do? Where's your stuff? They point to two big backpacks sitting on my studio floor. I said, you got to be kidding me. That's your stuff? And I guess I don't want to live a life like that. That's not something that's interesting to me. I want to go out with Cameron and have nice lunches and stick Goodman with the bill. But if at the end of the day, I would love it if I can pay for that. I mean, I want to do more than that. So there is a certain, I don't want to I don't want to necessarily do that hard scrabble. I'm going to live like a pauper. I like the richness of all the things in my life. But look, here's a cool thing about the FIRE movement. If it gets you questioning why you're doing certain things, like why you're living beyond your means or why you're striving to do something that's really not making you happy, then go ahead and make a change.
Yeah, that's a really good insight. And one of the conversations I had with somebody recently who has done this, or they're about to do it, they've positioned themselves to do it. and they don't want to do nothing. Like the RE part, the retire early part, they're going to do projects that they don't think are going to make a lot of money, but they are going to be intellectually stimulating, and they are going to enjoy doing that. They just don't expect an income from it, so they had to plan for that. So from that perspective, I get it.
Yeah, I totally get it. I mean, look, I think it's like annoying to me when I meet like these men and women of Wall Street who have gazillions of dollars and they're still working on Wall Street, because I'm like, well, why? Like, go do something good with your life. Go be meaningful. Go change the world whichever way you want to change it. But they like being in the game. So, all right, fine. I'm judgmental on both sides. Now I've just outed myself as a judgmental bitch. Fine.
So speaking of richness of life, Jill, I'm curious because on last week's podcast, Ben and I talked about the impact of many of the recent guests that we've had. And yes, it's recency bias. We love all our guests, but they've had an impact on us, how we practice and how we think. And I'm really curious because you've interviewed some pretty cool people in your career, people like Michael Lewis, Howard Marks, Annie Duke, and I'm sure many, many others that have had impact. Can you talk about impact that people have had on you that you've interviewed?
I was just out to lunch with my friend's daughter who just moved to New York, and she said to me, who is the most important, significant interview of your life? I've only been doing this for 10 years, okay? And you ready for the answer? Has nothing to do with financial stuff. Julie Andrews. I was fortunate enough to interview Julie Andrews in front of a live audience in London, and I did that in 2016.
Wow.
And she was gracious. She was delightful. She was engaged, and at 82 years old had reinvented herself 3 or 4 different times in her career. And there is nothing more rewarding than, basically interviewing someone you admire so much and finding out you really like that person too. And so to me, that was a life-changing event because number one, when I was asked to do it, it was a financial service company asked me to do it. And I was like, but this is not financial services. They're like, I know, we just like doing a boondoggle for our guys and gals. And, we just want you to come do this. And I said, what they didn't know is that I'm a huge Broadway musical fan and musical theater fan, and that I read every single thing about Julie Andrews. And what I learned in that moment was, actually, I can interview anyone about anything because I'm basically a voyeur and I'm naturally curious. And it was just a great gift. So to me, a life-changing experience. They flew me to London. They let me bring my sister with me, who is also a huge Julie Andrews fan. So that was the best experience ever. In the financial services, you know what? I love them all. It's hard to pick. I would say that sometimes I find that talking to real people, because part of my podcast is not just talking to people who write books and really smart people and doing that, but also talking to real people who have real problems. And frankly, the real people are much more gratifying because you feel like you're going to help them, not just help someone sell books like you guys are going to do for me. You really feel like you've made an impact, which is, I think, partially why you guys are in the business you're in, because you could do lots of different things with your life. There are a lot of different ways to make money, and providing financial advice and long-term planning is not an easy way to make a living. And part of the reason that people do it is not unlike doctors. You want to make a living, but you want to help people. And that is the most gratifying part of what I do.
So you may have just touched on it a little bit, but a question that we always like to finish with is, for you personally in your own life, how do you define success?
I like to think about my dad. My parents dropped me off to college. I played soccer in college, okay? And I was recruited. And went up to school early, and my parents dropped me off in front of the coach's office because we were going for the first meeting. There's nobody on campus. I was super scared just to be there. And I was like a little teary. And my father turned around and he says, don't forget, having fun counts too. And so when I think about success for me in my life, it has always been about, am I intellectually challenged? Am I doing something that allows me to do good and have fun? And am I learning something a little bit different as I go along my journey? That's success to me. I could have probably made a lot more money in my career had I stayed in trading longer, stayed in financial services longer, there's no doubt I would have made more money. I would never be having as much fun as I am having. I would never be as engaged as I am in the world and meeting new people like you guys and meeting people who really turn my world upside down and help me question some of my own assumptions. So that's a long way of saying it's good to have fun too.
That's a great answer. And this has been a really great discussion. So thank you very much for coming on the podcast.
Thank you guys so much for having me. I really appreciate it.
Yeah, Jill, thank you very much. And for sure, you passed along a lot of great ideas to our listeners. So thanks again.
Thank you. Thanks, guys.